Hi everyone, myself Murugan. Happy to present another interesting video from EQSIS. How to make the right decision. Do I need to be an option buyer or an option seller? In fact, this is a very common question we encounter from most of our clients that Murugan, tell me a strategy which goes really well as an option buyer to me. Or people ask me this question that as an option seller, I'm an option writer. Tell me what I can do so that I can optimize my returns. It's good that you can take a stance, but this is a video gives you a thought process for you to think in both the sides. This is not the video for someone who made up their mind to be an option buyer alone or option seller alone. By any chance, if you are flexible to adapt these strategies in line with the market behavior, then you should definitely watch this particular video. Let's get started. We have two ways by which we can time the market. One is by going with technical analysis, which is purely based on demand and supply. I think a very common note people use that the price actions. The other one is a statistical approach. But this particular video relies a lot on the statistical approach, less on the technical analysis. But you see some sort of a contradicting behavior sometime take place because a statistical approach, the way in which it behaves is quite different than the technical analysis. So what makes the option trader to become a buyer or a seller? I believe it a lot depends on premium. But to explain that, I just need the real market analogy. With that, you get this thought process. But to get the conviction, I can use some metrics from the implied volatility and percentile rank. And of course, to conclude this particular video, I'm going to give you an exercise to build a strategy which can make you to dynamically think when to become an option buyer and when to become an option seller. So I just want you people to stick to this particular flow, have a patience to understand everything in this particular flow so that you get it really right. Let's get started with this real market analogy. I hope you guys can see a two broad section of people. One into the agricultural business, farmers. The other one is the end consumer, but both were talking about the same product of tomato here. By any chance, if the tomato price is 90 per kg, which is way above the average price, that makes the end consumer feel a bit low and farmers feel really great about it because they get quite a good margin out of this business. By any chance, if the tomato price is 10 per kg, that makes them to think other way around that as an end consumer, you feel great that you hardly pay just 10 rupees to get the tomato, whereas the farmers, they feel a bit low because they don't even get the margins or sometimes it put them into a heavy loss as well. Coming back to a very interesting thought process is this. Just because the tomato price is 10, as an end consumer, if you start buying for tens or 20s of kgs, it makes no sense because as an end consumer, ideally what you wanted is maybe 1 or 2 kgs, that's all for a week. But if you take it for a 10s or 20 kgs, just because the price is low, you are making some fundamental mistake. Am I making sense to you? So just because the price is low, as a buyer, you don't go crazy to buy. Keep that in your mind. Same is true as a farmer. Just because if the prices are 10, if they think not to do this activity, they are making some mistake. I agree that the price can hit them badly, but some time back when the prices were 90, they were really happy about it. So in long run, it averages out. You get to know what margins. In fact, if you want, you can hedge and all different practices are different. But I'm talking about this. You should not change your mind just because the price fluctuation happens. This is the mindset the investor need to have. You just stick on to your activity and you keep doing it because that is what you originally needed. But that is not needed to explain this options program here. Because to explain that particular option concept, I'm actually introducing there is one more component which lies in between. Okay. And if you see, this is a food processing company. They are also dependent about the tomatoes here. I call them as a typical trader. And we need this mindset. Okay, I'm not talking from the end user or the farmers because most of you people think that they are the two participants. No, we have someone who's in between. They are typically called as a trader. They know how to become a buyer or a seller dynamically. And we need to have this approach. But try to understand, by any chance, if the price is 10, as a food processing unit, we make our a procurement team very aggressive, because when the price is 10 rupees, I ask them to go and buy as much as unit possible, and I ask them to run this mission 24/7 so that we can actually build a lot of sausages going forward. That is one way. But so my procurement team will be a lot more active. By any chance, if the rice price is 90, my marketing team will be a lot more active. My sales team will be a lot more active. We just want to position our product is much more, this product is much better than actually going for the fresh fruit, because the price is much more appealing to them. Now, if the prices were 90, they may not be showing much interest in procuring the product, because they know how to keep their shelf life for more time. So the idea is this, that the price over its fair price makes them to think dynamic. This thought process is needless for the end consumer as a homemaker, or this thought process is needless for the investors. This is the reason why the investor thought process and the trader thought process should be different. Being a trader, if you start following the Warren Buffett's investment thought process, it doesn't suit you well. That's very important anyway. Now get back to a final thing, that the typical trader deciding to be an aggressive buyer or aggressive seller, it really depends on price. Am I right? This is where we begin with this analogy. Now I'm just trying to connect this to an option trader, because option trader decided based on the current premium versus its fair premium. By any chance, if the product current premium is way above than its fair premium, then it's good to be a seller. But the big question is, how do I understand the fair premium? There is a two simple way by which we can find the fair premium. Okay. In this particular video, I'm going to talk about the first one slightly in detail. But if you guys are really interested, you guys can ask for the second way of doing it. But I can let you know what is the second way. But of course, if you're interested, if you find it makes a lot of sense, then you guys can definitely ask me in the comment section. Okay, let me talk about the first way of doing it, which is implied volatility. You may ask a question that, Murugan, the data what is presented in this particular screen, is it actual? No, it is not actual. It is taken just make you people to understand it better. That's all. It is a hypothetical number. In fact, I've created the random numbers to make you to present it. But of course, these numbers are available from a lot of softwares these days. Every other broker tends to offer this implied volatility, so you don't have to break your head. Let me first explain the concept, and if you get convinced, then we move forward. So now what you guys can see here is this, that the very first column here is the date. Okay. And I have taken the contract, which is Infosys, and I'm always referring at the money options. Okay. I'm always referring at the money option so that I can compare apple to apple. Okay. And I'm always using something called call option. Okay. And I'm actually comparing, it's a 5 days to expire, or you guys can take 10 days to expire or 15 days to expire. It's totally up to you. Okay. But in order to have a neutral note, I'm taking all for a 5 days to expiry. So I'm collecting the data as a very common note. So I'm taking the same underlying, I'm taking the same, the strike price, because I'm using the term at the money. So every month market may be different, but if I use the term at the money, I'm actually, it's going to have the same characteristics, and I'm using the same time period to expire. And look at the implied volatility collected over a period of time. Sometime the Jan 15, 2015, the implied volatility is 27% and 15%, 22%, 36%. Let it be, no problem. I already told you these numbers may be a hypothetical number, so don't stress much on those numbers. That's why I already told you it's hypothetical number. But what you people need to understand is this, that at times the implied volatility is very high. It actually tells me that the prevailing premium is way above its fair price. In fact, look at the percentile rank. Okay, now I hope you understand what is percentile. Okay, now let me give you in one quick note. If you look at 43, okay, when compared to all other numbers, 83% of numbers are below 43. That is what it tells me. And if you look at this, if you look at all other numbers, 97% of the numbers are below 47. So it actually tells me, like, if you look at I think I've taken half of the snap. Maybe it is extended, but look at this. A 47 is about 97%. Maybe if it is something like 48 or a 49 or 50. So as the IV goes to 50, it makes everything below that. You don't see anything around 50, am I right? You don't see anything around 50. So by any chance, if on November 2017, if implied volatility is 50, then the IV rank will come as 100. IV rank will come as what? 100. It means everything is below its current level. Everything is below its current level. Okay, coming back to the point which I'm trying to convey here is the red highlighted column literally let us know that these are all the time period that the implied volatility is very high. But try to understand, if implied volatility is very high, it conveys something else as well. Am I right? So we need to know that. But these are all the time where one should become a seller because you are getting more premium than the average. But you may have a different thought process. Murugan, market is paying more premium. Maybe market is expecting that side as well. True, that we are going to see that in detail. But before I move forward, I have a humble request to you people. By any chance, if you like this video, why not to share it? You may see a very simple share button at your, the YouTube, and you can click onto that. Probably you can share it in the WhatsApp or a Telegram, because that is the only way by which we find a few more audience, and it reaches a lot more people, and that will appreciate us to do this activity on an ongoing basis. If you find the content what we have is really good, only then you do it. If not, you can just skip this particular activity. Let me move forward. Anyway, if you do that, it really helps us. Anyway, move forward. Now, high implied volatility, there is a challenge, which I said some time back, right? If it is a high implied volatility, does it really mean that the prices were approaching to that, or is it overvalued? Because if you feel it is overvalued, we should go and sell it. But if you feel that the market has a realistic expectations, then we should follow that. That's a very big challenge. I don't know how many of you are getting it. Am I right? Let's say out of the money options, let's say the call option has an unusual premium. Now I have a two thought process. Is the premium is heavy, so it's good to sell and take that money, or probably there is a reason for a high premium, market may even go up. I don't know. Am I right? This creates the timing risk and theoretical trading, non-directional traders. So how do I handle this particular problem? I'm actually going to give you a very interesting thought process. Let me tell you one thing. By any chance, if you see a volatility like this, okay, now you can actually decide what to do, because now you guys can see when you take option chain, let's say you take Infosys option chain or a Nifty option chain or a Bank Nifty option chain, you guys can see out of the money, in the money, at the money. And if you look at the money implied volatility, sometime slightly average implied volatility, as usual, average implied volatility. And if you look at out of the money implied volatilities, I'm not talking about deep out of the money, I'm talking about slightly out of the money implied volatilities, or it is all slightly getting higher, and it is quickly getting higher. If that is the case, what ideally I should do? Of course, I can talk about that in a specific video. In fact, I wish to do that, but provided this is a content really liked by our audience that I don't know. So I want you people to do this exercise first, okay? And that is where we get to know how many of you shows interest in terms of the same thought process. Then we move forward. So if you feel that this is a scenario that people say it's a volatility smile, am I right? So I want you people to think about it. I want you people to tell me what strategy can do really well and why it can do well. That you guys can express in the comment section. And number two, there is something called at the money premium, am I right? There is something called at the money premium. So I told you there is two ways by which we can calculate the fair premium. One is by using implied volatility. That number you guys can even derive through Black-Scholes model, but it is very well available through various brokers terminal itself. So you don't have to break your head, okay? But by any chance, if you want to have the other simple way of doing it, which is at the money premium, okay? Because you guys can actually compare the current at the money premium versus the last month at the money premium for the given durations, okay, which we can definitely do it. So if you wish to have a video specific on that, you guys can ask me, okay, And if you're looking for such scanners in order to find a premium comparison using at the money premium, not for implied volatility, because we have already quite a good number of videos and the scanners where exist outside. But if you want to use it with respect to at the money premium, you guys can definitely ask me. So if you want to conclude this particular video, the purpose of you coming into this particular video, remember, you should know how to answer this particular one, because if implied volatility is high, we know universally a lot of people sell that particular thing to make money, but it also tells me that area is maybe likelihood. But when you see a scenario, this is very common scenario, what I've shown you people, at the money average implied volatility is around average or slightly low or slightly high, whereas the out of the money implied volatility is extremely high, compared to its previous scenario. Okay, so if that is a case, how do I form strategy? So give a minute, think about it, and then try to post it in a nice fashion in the comment section. I hope this thought process helps you to learn something new in this particular video. By any chance, if you want more videos to build strategies, if you want to know my strategy on high implied volatility scenario, you guys can vote for it in the below comment section. So I hope you guys can find some interesting content again from EQSIS, and do not forget to like and share, because it helps us definitely a lot. So as far as the upcoming videos are concerned, you guys can find it in the in the videos, and we also have a plan to post a video on more details on options, specific things. And a lot of you people shown interest on investing with EQSIS, with this the kind of a beta version which we are going to launch in another 5-10 days. So if you still shows that interest, you guys can actually put your thing in the below comment section that you are interested in the investment product from the EQSIS. That helps you to take diversified portfolio going forward. Thanks for all of you people joining us this time. Tell me.